Traders, welcome to QbarTrade. Today I will do quickly a weekend review and how would I set up my trades for the coming week and how does the market looks globally, what is the structure playing out. These are the few things which I usually review on the weekend, and I will do this thing today with you so you can also understand how could it add some better value in your trading as well. So let us start really from the global perspectives first. What I would really like to see is how the world market are playing around right now. So almost everything you're about to see traces back to two forces right now. The force one is the Fed turned hawkish, which means the Kevin Walsh, who overtook as the Fed chairman this year, and he's known for one thing: he doesn't like easy money. And the market had been pricing in rate cuts since 2026, if you know, and Wash was largely taken that off the table. When rate cuts get pushed out, borrowing gets more expensive, bond gets more attractive than stocks, as we know, and asset that don't pay you any yield, like gold and Bitcoin, gets less attractive to hold, and there's a reason the prices are falling for the gold and Bitcoin right now. And force two is the greatest force which I feel right now is the US-Iran conflict that escalated back in February this year, and the tension around the Strait of Hormuz. It's pushed up oil prices up and kept inflation sticky. US CPI ran near about 4.2 or 4.5% in May, and the hottest print since 2023. Sticky inflation push, hawkish Fed is a rough combination for risky assets. And now layering on top of both, a third worry that is a brand new this month is the new AI trade overhead. A Chinese lab called Moonshot AI put out a model that narrowed the gap with the two top US labs, and that alone was enough to spark a global chip sell-off. At TSMC guiding to higher spending, and Samsung AI numbers are disappointing, and the suddenly every index with heavy tech weighting is hitting everywhere in the world in the same way. So all these factors are playing out right now on a macro level. The pullback is due to really the semiconductors name dragged the whole market down. If you go and see the SMH semiconductor index, it is down by 9% over the 3 weeks now. What could play out from here is like if chip earnings over the next few weeks come in solid, this is a routine pullback inside a uptrend. But if AI spending guidance disappoint us, again, this could turn into a deeper, broader corrections because the tech is now such a huge weight in the index. The next index is Nasdaq 100. Again, a weekly chart. This is your moving average. It's sloping upwards, so I don't think here also there is any problem in the long term trend. But again, there will be some pullback coming in here like this. A deep pullback could be like this as well, due to all the semiconductor issues and everything going on. The sharpest move, this is one of the sharpest move, yeah, if you see this week, down about 4% if you calculate. So structurally it's about trend, but this is the index most exposed to the exact story I just told you: chips, AI, capex doubt, Samsung miss. This is a tech specific move, not a broad economic one. What's semiconductor again and any Fed commentary, those two things will decide if this stabilizes or extends. So next is like one of the oldest index, Dow Jones. Now Dow Jones is only down about 1% at 52,150, or if you can say. Notice it fell far less than Nasdaq. That's a tell. This is not the economic breaking sell off. It's tech valuations are getting questioned swell off. So old economy, non-tech name badly moved. The next is like Russell 2000 weekly index. Again, it's like small cap index which we see in our Indian market. Down just about 0.5%. The candle is really consolidating type, not a big body candle. It's a very small candle if you see, and it's within the last week range as well. So any break of this or the structure will really trigger a further move. Any break of any high or low of the structure. Again, the damage is concentrated, we can see, in AI and semiconductors name, and not spreading through the whole economy yet. Otherwise, it would have been, this index would have been here somewhere. Volatility, this is called as a fear index. So it is up about, I guess it's up about 25% odd this week, and the closing is 18.77. That's a real fear spike, but still 18, 19 weeks is still nervous and not panic. So panic starts about 30. So right now the market is repricing on the AI story, not pricing in the crisis. This is DAX, German index, Europe. Europe sitting near record high again. No problem here. Only down about 0.3% or something. Europe does not carry nearly the AI chip weighting the US and Japan do. So this week global sell-off barely touched it. UK 100 again. UK is this is FTSE 100. Now actually up this index is up about 1% this week. Fresh high, heavy in energy, banks and commodity. And with all prices elevated because of the Iran situation, that's helping FTSE and not hurting it. CAC 40 or France CAC 40, you can say, down about 0.5%, still above its weekly moving average. Same story as Germany, mild wobble, not a real hit. So notice the pattern already. This week's damage is concentrated exactly where AI and semiconductor conductor exposure is highest. US and Japan and barely visible where it is lowest, which is Europe. Still, we need to go and see the Japan index, but I'm very sure like even Japan would be damaged. Now let's look at the Asian index. So this is Japan index, Nikkei 225. This is very good, but look at this candle. Oh, so Nikkei, it's almost the body range is 10% from its open to close, of course, from high to low. Nikkei fell over 6% this week, more than 11% below its June 2025 peak. It's down right now. That's an official technical correction. This is entirely the cheap story. Kioxa lost about 16% in a week, Sumco over 15%, Screen holding over 12%. Japan index is more chip heavy than almost any other major market. So when AI valuation doubt this, Japan hit gets the hardest. What could play out? The market watching upcoming sector, earning closely, strong guidance could stabilize this situation given the index is still well about 30 weekly moving average. After this drop, cautious guidance could push it deeper toward 60,000 level. Some analysts are now flagging. So about here, which is a healthy pullback or healthy correction, I would call it as. Hang Seng Weekly actually held up better than mainland China this week, even posting a small gain on some session. It's below its 30 weekly moving average, still repairing, but it's proving more resilient because it's more internationally diversified, less export to purely domestic Chinese sentiment. Shanghai Composite, mainland China, down nearly about how much percentage is it? Could be approx 6.5%, breaking below its 30 weekly moving average. Three things hit at once: World Bank downgrade of China's growth forecast, domestic investor rotating out of AI and semiconductor names that had doubled in the first half year of the year to free up cash for major upcoming IPO, and the US Iran risk of flowing. This is the one chart on the board that just broke the trend, not just pulled back inside. If you see here, it's a clear trend break in China right now. DXY around 100.75, just above its 30 weekly moving average. This is the first one from the macro intro playing out directly. A hawkish Fed under wash is keeping the dollar firm after week 2025. Look at this USD INR. It's just moving up. Again, there is a new breakout which we can see. So a firm dollar plus India's own factor means the rupee weakening trend hasn't broken. This is the direct link between what's happening in Washington and what shows up in your zero, the app, you can call it as. US 10-year, it is at 4.549, elevated and range bound above 4% for over a year now. As long as Wash keeps rate cut hopes of the table, yields likely will stay elevated here. And that kept pressure on gold, on Bitcoin, and on high valuation growth stock. This is number one, is arguably driving three other chart on this board. This is really the number one cause. Brent crude, just zoom out the chart. Now again, it is trading in the high. It is elevated versus its post 2022 range because of the ongoing state of Hormuz tension. This is the direct inflation channel. As long as the Iran situation stay hot, oil stays a flow under inflation, which is exactly what the Fed's caution about the rate cutting. Gold, as we discussed, gold closed at 4,000 levels, down about 28% from its record high, above 5,600 level. Here's the actual mechanism. When the Wash was nominated as Fed chairman on January 13, gold dropped 16% in a single day as the market repriced away its easy money assumption. Since then, it has been consolidating in the 4,000 to 4,500 zone. But here's the most part people missing. Central bank, led by China, have bought gold for 17 straight months without pausing. Even though this entire correction, okay, this is the gold chart, and as we discussed earlier in the video, gold closed at 4,000 level, down about 28 percentage from its January record, above 5,600. Just the actual mechanism. When the Wash was nominated as Fed chairman on Jan 30, gold dropped 16% in a single day as the market repriced away its easy money assumption. Since then, it's been consolidating in the 4,000 to 4,500 zone. But here's the part most people missing. Central banks, led by the China, have bought gold for 17 straight months without pausing even through this entire correction. So you have got the short-term speculative money living because of rate, and long-term structural money, central banks still buying it. So if you see, this is all short-term money which is exiting right now, and still the central banks are holding the gold. I will share you the data of 2 years, which are the central banks which are continuously buying the gold, including India as well. So what could play out if Wash again signals any softening or inflation data? Cool, gold likely recover fast because the underlying bid never left. If yield keeps climbing, this consolidation could extend. Once we have the global perspective, let's look back into our home country. Let's look back into all the home indexes, Nifty, Bank Nifty, what they are trying to do right now, and what is the structure. And because everything I just showed you, the Fed, the AI fear, the oil shock, all of it lands here in India, and ways you can actually feel, not an abstract term, but really when we feel the inflation part, or your cousin's IT job, our monthly grocery bills. So let's just see. Let's start with Nifty first. So as you can see, Nifty right now, Nifty it's at 24,350 level approx,
And here's the thing most people don't say out loud. Now, Nifty has gone nowhere in 1 year. It hit an all time high near 26,300, which was back in September or something. And after that, and 2024, this point, and again 2025, but it did not cross this level of the previous high. And since then, it's basically been stuck in the box up to 25,000, down to 22,000, back up, back down. If you bought at the top of that range, somewhere here in 26 on Jan or December or in September 24, October, you'll be wondering your portfolio is not performing and it feels flat. This is the chart, it is why it's not you. The index itself is directionless since then. Sensex, it has the same story. What it is Nifty. This more of like an identical index. Bank Nifty. This is turning out to be very well right now. If you see, I just need this moving average structure a bit upward sloping right now, so it can confirm the red. But I think once this level has been broken, which is 58,700 or 800 odd, it may go up to 61,000 again here, because over the weekend also there were many results which I need to see as well. Big banks like ICICI and HDFC have reported the results. I will just go through it after this video is completed. But the sector is one of the very bullish, and the charts are looking promising right now in terms of investment perspective as well. Oh, let's look at Nifty 500. Same box, same story on the broader 500 stock index. This isn't the one index being weird. The entire market has been range bound. So why hasn't it crashed? If the picture is this uncertain, this is the part I actually want you to remember. So in 2026, foreign investors (FII) pulled out roughly 2.7 lakh crore rupees from Indian stocks. That is a genuinely massive number. In a normal world, that kind of foreign exit could cause a crashes. It didn't happen here. You know why? Because Indian mutual funds DII bought back over 4.16 lakh crore. And where does that DII money come from? From our SIP, your SIP, my SIP. Every day we contribute from 500 rupees to 50,000, which gets auto debited from our salary accounts. So right now, there is lots of DIF fund flowing into the market via our own SIPs. In March 2026 alone, the worst month when Nifty fell 11% in 30 days, FIS sold about 1.2 lakh crore. DIS bought 1.36 lakh crore in that same month. That's not a coincidence, that's a structure. Your SIP is not just a personal finance habit anymore. At national scale, it is a literally one of the two forces holding up the Indian stock market against the foreign selling. Next time someone tells you SIP are boring, tell them boring is what saved the index in March. Okay, now again, let's go to Bank Nifty once more. So if you see, it's really near the record high as well, comfortably above that 30-week moving average. While the US Fed is holding rates high, RBI has actually been cutting repo rate down to 5.25%, with some bank expecting it to go 5%. Lower rates are oxygen for banks, and for anyone with a home loan or a business loan may know this thing. This is the single strongest large chart on the entire Indian board right now. Private bank, if you see private bank index, let me just pull up. Again, it is same like Bank Nifty, but yeah, you can see the breakout has been playing out now. Candle which close is very good and very wide body as well. Volumes are not that good, which I can see in the below panel. I think if volume would be something like this, I would be more than happy to go and buy it here somewhere. Then we can have a look at which one should we pick up? I think we can pick up PSU weekly. Let me see PSU bank index. 8,300 level. Look at the stars from 2020 to today. On the higher time frame, if you see, the index has gone roughly approx 7 to 8 times. So usually we used to say this is a dead money earlier, but look at this fabulous growth. Now let me talk about Nifty IT index, which is something really interesting happening here right now. It is on lower side of the whole market. See here, prices of 2021 are here now, 25,800 level. So now here's the one that actually touches people lives directly as well, Nifty IT, and it picked near 46,000 approx, and which was 2024. It's now closed down to 30% from that level. Let me just check. Oh, it is approx 42% down. So that's one of the worst correction Indian IT stocks have seen over a decade, and the only reason is two words: AI fear. The entire IT industry, TCS, Info, HCL, Mahindra, make its money by doing work for US big companies, which we know. Right now, big US company are asking themselves, why pay an Indian IT firm for 500 people to do this work when AI tools might do with some 50? Nobody has a final answer yet, to be honest. But the fear alone has been enough to hammer the stocks. And add, and add to that, Essentials, a US competitor, cutting down its own growth guidance in June, and it triggered a chain reaction straight through Infosys, TCS, Wipro, and everyone. Now, when we see this thing that from 500 people of workforce, it will come down to 50. But I was recently reading an article wherein the AI credits which have been consumed by this 50 folks is equivalent to paying to the 500 employee which they were hiring earlier. So now they have a specialist, a CFO, who looks that the company's costs are not increasing day by day and controlling it on AI infra. So this is another worry right now which companies are facing. So IT index, I think one day it will play out well. Maybe it's definitely it's not going to happen this thing. Tomorrow it's going to be here. But in the long term, I think this will do this, and finally it will break its peak. And the real question which you need to ask is, you, me, and many people like us have started using AI so comprehensively in their daily lives. And do you think that company like TCS and HCL wouldn't be thinking like how they will overcome these difficulties of AIs? Of course, they have thought through it, and sooner or later, there will be a very good news is coming in for Indian IT sector, and the prices will shot up again. The next index I want to look at is the FMCG index. Now, FMCG, the company that makes soap, biscuit, tea, the noodles in your kitchen, HULITC, Dabur, Britannia, Nestle. The index is around 48,750. Now, FMCG is supposed to be boring, safe, defensive part of the market. It hasn't been safe in this time. Why is this happening? A real few reasons, and you'll recognize every one of them from your own life. Like, is rural demand has been soft, bad harvests, unpredictable weather. Urban demand has been soft too. Inflation has been eating into what middle class families have left over after rent and essential things. Input cost, palm oil, packaging have gone up because the rupee has weakened, which makes the imported raw material more expensive. And a few newer factor quick commerce apps like Blanket and Zepto are changing where people actually buy their soap and shampoo, disrupting the old distribution network this company built over the decades. So next time you notice your monthly grocery bills creeping up while the pack size quietly shrinks, that's not your imagination. That's the chart playing out in your kitchen. Next sector which is interesting to see is Nifty Reality. You can see recently the Nifty Reality Index has moved up and it's trying to regain its momentum. Just look at the longer term chart. Beautiful structure. Let's see how it play out here. If it breaks this levels of 960 or something, I'm hoping the next move would be around 1000 or something. But we need to wait and watch Godrej Property, Prestige, and all other big board results right now. And it also defines the economy as well, how it's playing out. And let's look at India VIX as well. So if you see India VIX is like right now at 13.15, and what we saw in the US it was approx 18 right now. As we can see, like there is so much fear in the market of AI hammering and other things, but Indian option traders are pricing in less fear than usual, not more. That can mean one of two things: either the market genuinely believe the worst is behind us, or, and this is one that I would bet on if I had to choose, people are getting compliance and selling premium cheap and not respecting how much uncertainty is actually sitting on the table right now. If you are writing option for income, this is exactly the environment where you get paid the least for the risk you are carrying. Worth knowing before you place your next trade. And rupee, again, we talked in the last global markets. It's a one-way street right now for the rupee.